Good afternoon, everybody. Welcome to this financial wellbeing webinar for the ICE BEM Fund and the Support Network, where we're going to be looking at investments for beginners. Now, this webinar is aimed at people with little or kind of no knowledge of investing, with the aim really to give you the confidence to start your investment journey. So just to recap, my name's Katie Vine. I'm the director of Better with Money. And we provide sort of workplace financial education, but also we support many benevolent funds and membership organisations as well. And I'm going to be your presenter for today. Now, just a couple of notes before I begin. This webinar is providing information only, so there isn't any financial advice being given. We aim to give you just sort of the tools and the knowledge really to be able to make your own decisions around whether investing is right for you. But also it's important to know that Better with Money is not connected to any other organisation, and it doesn't have any products to sell. So the information that we are giving you today is just independent and unbiased. Now, my mission today is to combat the feeling that kind of investments are too complicated, but also to kind of demystify some of the jargon that's associated with it. And to do that, what we're going to be doing is we're going to run through what is investing, first and foremost. Then we're going to look at the basics of investing, so the types of things you can invest in, what are stocks, shares, funds and portfolios, and also how to manage that risk. And then we're going to finish off by looking at where you could start investing your money and the 5 golden rules to stick to. Now, if I was to ask you right now to imagine somebody who invests, who would you be sort of imagining? Who would you be thinking of? Would it maybe be the image of a man, perhaps in a suit, fairly well dressed and possibly quite well off? The stereotype tends to be Leonardo DiCaprio, Wolf of Wall Street, which we've kind of got pictured on the slide here. Well, why would is wipe that from your mind, because actually anyone can be an investor. And most importantly, you know, that person could be yourself. So what is investing? Well, in simple terms, investing is the act of committing money to something with the reasonable expectation of obtaining additional income or profit. So investing isn't gambling, where the outcome is sort of totally unknown or a get-rich-quick scheme. It's simply a way of getting your money to work for you rather than you just kind of working for money. Now, growing up, many of us were kind of taught that you can earn an income by getting a job and working, and that is obviously what most of us do. However, there's a slight problem with that in the sense that if you want more money, then you have to work more hours, but there's actually a limit to how many hours we can work, obviously, in a day. And having money is no fun if we don't actually have the leisure time to then enjoy it. So actually, investing money is also a way of getting your money to work for you whilst you are doing those other things. Now, we'll also see as we go through the webinar, that investing is usually appropriate to sort of achieve the mid-term to long-term money goals that we set ourselves, such for kind of saving for retirement. So investing isn't only for sort of people such as financial advisors or mathematicians or certainly wealthy people. It really is for everybody. And you can play a part in the level of risk that you're prepared to take and the level of depth that you're happy to be sort of invested in as well. So if we start by looking at the basics of investing to help you to get a feel for whether investing is for you, then first we'll look at the differences between cash and investing. We're then going to have a look at patterns that we see in investments, and then a wider view of how the different things make up those investment portfolios that actually you can invest in. Then take that little more depth into look at stocks and shares. And then I'll explain what a fund is and why investing in a fund may help you to kind of reduce the risk. So let's talk about cash and investment and the 2 ways of holding your money. Now, cash is not actually classed as an investment. Any capital held in cash is not at risk of decreasing, which is its main appeal. So if you keep your money in the bank as a kind of cash savings, and you'll receive an interest rate, which is linked to the Bank of England base rate. And typically, if you lock your money in for longer through a kind of fixed term savings, then the bank will give you a better interest rate. Now, at the moment, the kind of top kind of easy access accounts are paying between 1 to 1.5% interest, and fixed term savings sort of are now around sort of 2.5%. That said, if you hold a lot of your money in cash over a long period of time, you run the risk that your money won't keep pace with inflation. And it can actually then lose the real value the real value over time. So if we have a look at the economy at the moment, inflation is currently at 9%, which means that the things we buy are 9% more expensive than even what they were last year. So if we have our money in the bank and we're only receiving 1% of interest, then we won't be able to buy as much with that money next year as what we can this year if inflation stays at that level and the cost of living continues to go up. Now, cash absolutely has a place within our kind of savings framework, and especially if you're saving for something which is going to happen in the short term and you don't want to put any capital at risk. So, for example, if you needed, let's say, 20,000 for a house deposit, which you hopefully are seeing happen in the next sort of few months, and you have 20,000, you're likely to keep that in a cash account where it's not going to lose any value. It's easily accessible when you need it. And also there might be a very, very small interest that's being accrued on the top as well. Other good examples as to where you may save cash pots are for emergency funds, home renovations, kind of holidays, or perhaps even a Christmas fund. Now, when someone chooses to invest, it's almost always due to the potential of getting a better return than cash, especially now whilst interest rates are still relatively low, but inflation is rising. And when you invest, you're hoping that the thing that you invest in will increase the price and your money will be then worth more at the end. So perhaps you invest in a property, a piece of art, but often people will invest in companies in the hope that their share price will increase in value. Now, companies allow this because they need your money to grow their business, ultimately boost their profits, but also they want to turn that business into financial success. So the share price of that company will rise if their service is in demand and doing well, or it also could fall if buyers think that the firm will struggle. So investments are linked to the markets, and there is no guarantee for that rate of return. Now, your money can go up and down, it can fluctuate, so capital is at risk and you could get back less than what you paid in. Now, the unknown return and the potential to lose money is often what kind of can put people off. But with some understanding of how kind of investing works, it can become a lot less daunting. So the first golden rule of investing is that time is key. And investing for long-term goals can make sense. So historically, looking back over sort of 10-year periods, investing in the stock market has always outperformed cash returns. Now, that's not to say that that is what is going to happen in the future, but it's important for us to look at the investment patterns a little bit more closely. So if you look at the graph that's showing on the right-hand side of the slide, it shows that the FTSE 100 performance since 1995. And the FTSE 100, for anybody that isn't comfortable, is simply just the 100 biggest companies in the UK in terms of their capital value. Now, as you can see, the value of the FTSE 100 goes up and it goes down over time, and that term is known as volatility. Now, markets will see disruptions, downturns, such as kind of the property downturn in 2008. We obviously had the COVID pandemic in 2020. And then more recent, we've had the Ukraine war. And those events will always hit the news. But what is less broadcasted is that markets also recover. So, for example, at the beginning of the COVID pandemics, markets fell by around 25%, but actually within 6 months, they had fully recovered. Now, other factors can also trigger this volatility globally and locally. So a great example was actually seen with Tesla. When Elon Musk kind of smoked weed on a podcast in September 2018, two very senior people announced kind of leaving the board, and needless to say, the stock price dropped by 9% in one day. So if volatility when investing is a given, what we want to ask our question, is what is the kind of workaround? And the workaround is time. So we'll keep coming back to this because it really is the golden rule. Time will allow you to ride out these ups and downs. The longer you leave your money invested, typically the less exposed to the downside you're going to be. Now, Warren Buffett, arguably one of the most successful investors of all time, summarized, it's not about the timing of the market, it's about time in the market. So there are lots of different things to invest your money in. And for the majority of this webinar, we're going to be concentrating on investing in companies. But I just thought it would be worth touching on some of the other assets that you may have heard about as well. So we've got cryptocurrencies. So cryptocurrencies are digital currencies that are managed by a network of computers. And these kind of allow cryptocurrencies to operate without a central authority, such as a bank. They are designed to be free from government control. And as of March this year, there were actually 18,000 cryptocurrencies, with some of the more well-known ones being Bitcoin, Litecoin, Stellar, and Dogecoin. And a good comparison for crypto is to think about the arcade tokens or the casino chips. You'll need to exchange real currency for the cryptocurrency, which can then be used to kind of buy goods or services in the places that you're in. Just like you kind of do now, really, when you're in the games arcade. So from an investment standpoint, the value of a cryptocurrency can fluctuate dramatically, simply because there is no central authority governing them. The potential for kind of high returns can be really attractive to people, but you can also get the corresponding lows too, which makes cryptocurrencies less appealing to beginners who are essentially gaining their confidence with investing. And a really important point to note around cryptocurrency, which I touched on, but it is the fact that it is an unregulated environment. So as much as people have maybe stood to make lots of money, there have certainly been huge example of people losing lots of their money as well. So it's something to really be mindful of. Now, non-tangible tokens can be things like photos, videos, files, or anything really that can be traded digitally. So the first sort of NFT was a video that sold for $4 during a live presentation. Digital art is also a good example of an NFT, so that non-fungible tokens. All of the precious metals. So gold is still the most popular as an investment. The gold market is subject to kind of speculation and volatility, just as other markets are. But like most commodities, the price of gold is actually driven by sort of supply and demand. And I have seen actually through some of the questions that have been automatically sort of popping up, one of the questions was, is there any sort of general advice around investments that are able to protect against inflation? And actually commodities would feature in that place. So they are typically, commodities are designed to be invested in for that reason, so that they potentially can inflation proof, because arguably if inflation's going up, it means the demand for those basket of goods and services are going up as well. So hopefully that answers some question that I saw pop in there. And property is probably more self-explanatory. Individuals or companies buy property in the hope that obviously it will provide rental income, it will increase in capital value over time, and in order to give them some return on their money. What we're going to concentrate on here is now investing kind of in companies, so known as sort of stocks and shares. And these are the types of assets you usually have the opportunity to invest in through your workplace pension scheme as well. So a stock, or more commonly known in the UK as a share or an equity, is part ownership of a company. So when you buy a share, it means you actually own a piece of that company. Shares are usually divided into units, and when you invest in that company, you get units for your money. So let's say, for example, each unit costs £1. You invested £100, you would have 100 units in that company. If the share price doubled and each unit was now worth £2, you'd have £200. And if it fell to 50p, then your share value would only be worth £50 at that moment in time. Now, sometimes companies share their profits, and that's what's known as a payout. And you would know that as a dividend, which is another way of making money when you invest as well, and receiving a form of income from your investment. And then on to bonds. So bonds are issued by the government and corporations when they want to raise money. So if you buy a bond, you don't actually have any ownership rights, meaning that you don't necessarily benefit from the company's growth, but it also means you won't be impacted if the company isn't doing well either. So by buying a bond, you're sort of giving the issuer a loan, and then in return, they agree to pay you back the face value of the loan on a specific date, and an agreement to pay you periodic interest payments along the way. And that's sort of typically twice a year. If the bond is issued by the government, then it's actually called a gilt. And it's considered to be low risk, as the UK government is unlikely to collapse, despite perhaps what we're seeing politically playing out currently. Corporate bonds, which are bonds issued by companies, can come with more risk depending on the corporation. So if you buy bonds from, let's say, Lloyds Bank, being an institution that's been around for many years, it would be perceived to be pretty low risk and the interest might be lower. Whereas if you were to buy bonds from a lesser known or established company with less security, then the risk of not being paid back is higher. So therefore, the interest payment would most likely be higher in that circumstance as well. Now, with almost all investing, risk and returns are directly correlated, so that the more risk you take, the higher the more potential returns. So that risk and reward is particularly applicable when it comes to investing. And the last one on the slide is a fund. So a fund being sort of a pool of money from lots of different investors like yourselves, and to hold a variety of different asset classes such as shares and bonds. So it's a collective investment, and a fund manager chooses which assets to buy and invest the money on your behalf. Now, because the funds are usually held on such a large range of assets, it means you're not having all your eggs in one basket. You're spreading the money across a variety of different investments. So you're diversifying, and obviously that term is known as diversification, which is intended to spread the risk. Because if one of those shares in the fund was to fall in value, the other shares in there help to dilute the effects on the overall price. It will decrease, of course, but less than if you'd just been invested in that one company. So diversification really is key, and that's very much how those collective investment through funds are designed to work. Now, if you are somebody looking for a sort of straightforward or an easy way to invest, where you've got a good spread of risk and someone else makes the decisions about which assets to buy, then a fund is a really good place to start. Of course, kind of having that service does come at a cost, and there is a fee that fund managers charge for this service. So where you hear the term annual management charge or fund management charge, that's basically the cost of managing the fund, and it's usually quoted as a percentage of your fund value. Now, there's two types of funds to be aware of: active and passive. Active basically means that there's a person or a team of people actively managing your funds and choosing which stocks and shares they pick. And they do this by kind of undertaking ongoing research, analysis. They're buying and selling shares when necessary. So management fees for active funds will be higher than what you'll find for passive funds. Now, passive funds, also known as index tracking funds, they're called passive because they are not being actively managed. So these funds aim to match the performance of a particular stock market index or another benchmark. So, for example, they may invest in every share in the FTSE 100. So every time a company moves in and out of the FTSE 100, the fund changes the shares it holds accordingly so that it tracks the index. Now, passive fund fees are lower as they require less kind of day-to-day management, and in many cases it is actually done by a computer and through a series of algorithms. Now, funds usually have a theme, and that basically means that all the investments within a sort of named fund will loosely be related in some way. So examples being geographical focus. So it could be linked to assets in developing countries or simply all of the companies in the FTSE 100. It could be sector driven. So in that example, all those stocks may be invested in retail companies or tech or manufacturing. Or ESG, which stands for environmental, social and governance, and may only include companies who are actively changing their working practices to address climate change, for example. So if you want to spread your risk further, then you can invest in a portfolio. And portfolios are a mix of funds. So in theory, if one fund stops performing well, then the other funds would help to keep up the average of the overall portfolio performance. And therefore, also your return would be less impacted if one fund didn't perform well. So we've had a look at investing in funds or portfolios as a way of kind of managing risk through diversification. But I want to have a look to see what else can be done to manage risk when investing. So the next one on the list is pound cost averaging, which is investment jargon. And so let's actually kind of work through what that means. So pound cost averaging is when you drip feed money in to investments on a regular basis. And the idea here is that it makes you less exposed to the ups and the downs of the market. So let's say you were to invest a lump sum of £5,000, for example, you put it all in when the market was at an all-time high. If the market drops, then your full £5,000 is exposed to that drop. Whereas if over 5 months you invested £1,000 per month, the idea is you will have invested whilst the market was at different points, and therefore you've averaged out prices at which you bought into the fund, and therefore you are less exposed to those falls in the stock market. But obviously we can't necessarily predict when markets will go up and down, and it's difficult to say whether you'd be better off putting a lump sum in or drip feeding it for a particular investment. So it's about investing at a time that suits you. So if you are investing longer term, then both styles have actually proven to get good returns. And by long term, we would say 5 to 10 years in order to ride out kind of any fluctuations. Now, the worst drop in the UK stock market was actually between 1972 and 1974, when it dropped by 73% due to the oil crisis. And the miners basically went on strike, which led to the government enforcing 3-day weeks. Now, companies were not allowed to open, use electricity for more than 3 days. But by 1979, so 5 years later, the markets had recovered. And by 1986, they'd actually risen by another 100%. So time is key. Investing for the long term does give you more chance of riding out volatility. And that's really why the next point is don't panic. So if you see markets fall, don't try and take your money out of the investment, as all you will actually do is consolidate your losses at that point, and it doesn't give you the opportunity for your stocks to recover in value. The aim is to kind of leave it as it is, let the markets recover and rise, and historically, as it has done every decade over the last 100 years. That then brings me to the last point. When markets are low, it means that the units of those stocks are cheaper to buy. So therefore, it could be a good opportunity to invest more, get more units for your money, so that as markets recover, your investments then rise in value. But if we think about pensions, they take advantage of all of these things. So pension default funds are usually invested in funds and portfolios in order to spread the risk through diversification. And as your money is paid into your pension each month, that takes advantage of that pound cost averaging as you're drip feeding your investments. And by its very nature, you can't access pension savings until you're at least 55 anyway. So your investment for over 5 years, and because of the long-term nature of pensions, you will be buying units in some funds when markets are very, very low, such as when the pandemic first hit, the Ukraine war started, for example. So age also plays a part in investing. Someone who's close to retirement may want to take less risk with their investments, and they don't want to lose money before they stop work. They want to rely on their savings. So instead, they would choose to keep their money in cash and bonds where the capital sum won't go down. Meanwhile, there is usually the reverse. So if somebody was in their late teens or early 20s, they have an asset that you can't buy, and that's time on your hands. So having the next 40 odd years or so to grow investment pots, absorb any dips in returns, is a big advantage for investing. Also, any interest or any investment returns you receive remain invested. You can start to receive investment returns on it as well, which is then known as compound returns. And obviously that effect of compounding is very, very powerful. So we kind of know the basics of investing. So let's have a look at where we could invest our money. So we've spoken about investing in pensions for long-term savings, but any money you put into pension, you can't access until you're 55, and that age is rising to 57 with effect in 2028. So if you don't want to tie your money up for that long, then you could consider the stocks and shares ISA. An ISA is simply an investment product where you can save money either in cash or in stocks and shares. And the advantage of an ISA over other investment accounts is that the interest or investment returns are tax-free. And if your fund grows significantly, when you withdraw the money, you don't pay any capital gain tax either. You also don't need to declare ISAs on your tax returns. Now, there are many providers of ISAs on the slide here. We've just outlined some of the companies that specialise in providing investments for beginners. So such as Nutmeg, you've got Moneybox, Plum, Wombat and Wealthify. They tend to have ready-made fund selections and portfolios based on your own attitude to risk, and they are low cost. Now, Money Helper has a great guide to investing for beginners, so you can always find out more information about ISAs available and what to look for as well on the money saving expert websites. Brilliant guides on there as well. And just to sort of finish the webinar today, I just want to remind ourselves of those sort of 5 golden rules of investing. So firstly, the bigger the level of risk you take, the higher the potential for returns, but think carefully about your approach to risk. You may be more comfortable opting for a less risky investment, so even if returns are likely to be lower. Remember, though, that no investment comes without risk, so there's always the chance that you could get less back than what you put in. Secondly, don't put all your eggs in one basket. So diversification is key. Spreading your money across a different range of assets and geographical areas means that you won't be depending too heavily on one investment or one region. And that means also if one of them performs badly, hopefully some of your other investments will make up for those losses, although obviously there are no guarantees. Thirdly, invest for the long term. So investing should never be considered a get rich quick scheme. You need to remain invested for at least 5 years, but preferably much longer in order to give your investment the best chance of providing the returns that you're hoping for. even then, you must be comfortable in kind of accepting that the risk that you could get less actually than what you put in. So if your investment goals are short term, so for example, sort of 1 or 2 years away, then investing wouldn't be right for you, because you want to keep that money readily accessible and also in a kind of risk-free environment. And fourth, don't try and time the market. So in an ideal world, you'd be able to buy investments just before they increase in value and then sell them before they fall. However, obviously, nobody knows the way the stock market's going to move. We haven't got that crystal ball. So trying to predict market ups and downs, known as volatility, could mean that you actually end up buying or selling just at the wrong time. Don't panic. Keep your investment under review, but don't be tempted to keep kind of buying and selling shares, because you could just be locking in the losses. And lastly, number 5, sort of never invest in anything you don't understand. So before you put your money into an investment, take time to research it thoroughly so that you understand exactly what's involved and what the risks are. Every fund should have a key information document, so known as a KID, which explains the fund's key features, the charges, the stock market summary, the performance. So it's really important that you read that before you invest, because if you decide to invest in an individual business, then you need to make sure that you know what that company does and how it plans to make money in the future. And although sort of too much tinkering with your investments isn't usually a good idea, it doesn't mean that you should just forget about them. So your investments will change in value over time, depending on the returns you receive. So you may need to rebalance your portfolio from time to time, if you're not invested in a fund where the fund manager is doing it for you, and just make sure you're moving it in line with your lifestyle and your attitude to risk, as well. I'm very conscious of time. I can see there's lots and lots of areas in the chat box, so I think it's probably worthwhile us just scooting through them just to make sure we've answered as many questions as we can.
Hi, Katie. I'll just read through some of these questions. So the first one, what questions should one ask of a financial advisor to ensure they are reliable and trustworthy?
So the first thing is to make sure that they are obviously authorised to be doing the role that they're doing. So you can actually go online and you can search for a financial advisor that they are registered with the financial conduct authorities. So you want them to be FCA approved. You also want to understand what qualifications they've got as well. So the latest minimum requirement for a financial advisor giving advice now is to be diploma level qualified. So firstly, you want to make sure that they've got their level 4 diploma, if not more. So if they're chartered, obviously that's even better. But also it's about, having a free chat with them first, because people buy people at the end of the day, and it's very important your personalities suit each other. Any financial advisor that's worth their weight will always allow you to have a kind of getting to know you session for free. So I'd really encourage that you use that. But yeah, absolutely exploring their qualifications, checking they're registered, and then having a chat with them to see what their expertise are and how you feel you would work with them as a personality.
Thank you. Considering the low interest on bonds and the high rate of inflation, is the 60-40 bond stock rule of thumb dead?
No, so that's still very much a school of thought, but like all of these things, they are schools of thought, purely because it would be a 60-40 split that is actually designed to keep pace with inflation. But again, it comes down to diversification. So certainly with what is happening economically, what you'll tend to find in lots of people's investment strategies are very diverse. So that they are perhaps having a level of investment in 60-40 kind of split, but they would also perhaps have some commodities like some gold in there, and then they would also have some equities that are perhaps specialising in quite focused market areas. So really it's all about diversification, but all of these things are just schools of thought. You have to go with how it suits your own attitude to risk.
Thank you. There's two questions. I'll read them both, but I think they have the same, probably the same import. Can you provide some guidance on reliable source of information for investment performance and associated risk and rewards? And is there a manual I can refer to when I want to start investing?
Yep, so basically there's a brilliant investing guide on Money Helper, which is a government website, and I would point you all to. With regards to looking at accurate fund performance, it depends who you're taking the funds out with. So if it was your pension scheme, for example, then your pension provider will have those key features for every single fund that you've got the opportunity. So a fund fact sheet. In the same way, if you go into an ISA, a stocks and shares ISA, you should be able to get access to individual fund fact sheets for any fund, and that basically shows the past performance, the areas of the market it's investing in, but also it will show you any stock market commentary, and also the fund managers commentary as well around what they feel the challenges of that fund could be, but also how it's geared for the future.
Thank you. We've got quite a few questions, Katie. I wonder whether I will give you one more and maybe we could look at the rest and produce something to send to people afterwards.
Yeah, absolutely. Yeah, happy to do it.
Right. Okay.
Problems.
So the last question is, are ISAs available to non-residents of the UK?
No, they're not. They are very much a UK-based product, purely because the tax wrapper that sits around them. There are some forms of, obviously, there's lots of investments that are available for somebody overseas. There's also, if you're in a kind of tax-sheltered country, so a tax haven, there's obviously lots of sort of overseas investments that are in place. But an actual ISA is very much governed by UK legislation, because it's a tax wrapper that sits around it for tax efficiency.
That's great. Thank you.